Stocks getting a lift on hopes for trade progress when the U.S. and China meet over the weekend in Switzerland. But is there any material change for investors who are worried about headwinds from the trade war? Joining us now, we've got Ed Yardeni, Yardeni Research President. Ed, great to have you here with us. As we're waiting for details to really emerge from either side, because there have been very different narratives that both countries and multiple countries are really telling when it comes to how they're going about negotiations and whether talks have actually started or not. What will be the material driving force behind these deals from your perspective?
Well, at the end of the day, it's going to be up to President Donald Trump whether there are deals or not. I mean, yesterday, he sounded like he was ready to declare victory, that he would entertain the possibility of having deals that weren't in writing. I think he's got to get this issue behind him by the summer. I think there will be deals. Some of them will be a couple of pages long, and there'll be frameworks for discussing, for further discussions, and they'll be signed. Others will just be verbal agreements. I think there will be some sort of modus operandi with China, but Trump really can't afford to have this all lead to a recession in the second half of the year and into next year. And the reason for that is that the midterm elections are coming up. God bless America. We have a system called checks and balances, and it works great. Any administration has to consider not only the next presidential election, but the midterms. And so that's an issue. And the Chinese are also under a lot of pressure to get this thing resolved, because there are already some reports of social unrest from people that aren't getting paid and are losing their jobs because they're losing the American market.
So Ed, talk to me about this kind of being a slow-moving barge. When I talk to my sources in Washington, they point to the fact that this took years the first time Trump was in office in terms of getting a deal with China. How do you trade around that uncertainty?
Well, I think that the markets have figured out that that's what you've got to do, that the uncertainty, the volatility, the fact that the president makes a comment every day that seems to potentially be market moving. I think at some point the market starts to move on and focus on other things. Let's not forget that some of this correction we've seen in the S&P 500, and it was a correction, it wasn't a bear market, and I think the bull market is resuming, but let's not forget that some of it had to do with questioning about AI infrastructure spending. It was the Magnificent Seven that really were down 25%, bringing the market down 18%. And the reason the Magnificent Seven got basically into a very short-term bear market is DeepSeek was introduced in January and raised questions about whether these companies were spending money that they were never going to get any return on. And now with the earnings reports, they're making it clear that they think they're going to move forward with their spending and that they will get a return on it.
Doesn't that pose kind of a double whammy, though, if you have on one end the additive competitive threat, of course, which is natural in any open market, but then you also have, which is what the markets were clearly moving in more outsized fashion on, Liberation Day comments, and then we're starting negotiations or pausing the tariffs for 90 days. And that was some of the more severe price action correlation that we were watching here. And so that in mind, I guess the question is, when you have kind of that double whammy of both, you're also now sucking out some of the potential growth for those semiconductor names that had really been the kind of poster children for the rally that we've seen over the past 2 years.
Well, the data shows that spending is still quite strong in the technology area. I mean, the earnings reports didn't indicate that anybody was really cutting back on their capital spending budgets. Look, AI is basically just an evolution of what I call the digital revolution. And the real, what AI is really all about is increasing the demand for processing information, data, and that requires more and more infrastructure. So it's really all about expanding the capacity of cloud computing, and I don't think that's changed at all. And then, of course, we've got a shortage of labor, which needs to be solved with productivity, and productivity comes from technology.
So just to clarify as well, I guess what I'm also asking here on top of that, though, is
Yep.
Is it still as strong? Is the market still as wide for all of these companies if you also have a deglobalization effort that's taking place at the same time?
Well, again, I think we want to be careful about extrapolating short-term statements, short-term events for where this is all going. I don't really see this leading to deglobalization. I think we're going to be just seeing a greater diversification of supply chains. I mean, this has been going on for a while anyway, since Trump 1.0. Even under Biden, there was a move away from China to Vietnam and Mexico and Canada. I think what Trump is protesting is that the Chinese used some of these countries as back doors for dumping their products anyways in the United States. The Europeans are getting dumped on with electric vehicle cars. It's creating a real mess for their auto industry. So I think you're just going to see a lot of pushback, mostly against China. And I think overall, the global economy is going to continue to grow and be interdependent. That's just not going to change.
And based on your notes, I know that you do see the U.S. economy as resilient in the face of the tariff turmoil,
Yes.
but you do say a recession is still a possibility.
Sure.
On our Fed day here, I'm curious, is stagflation or a recession worse? Because with stagflation, at least the Fed could potentially, or with stagflation, the Fed has less room than they do in a recession.
I think in the short term, you're going to see more inflation than stagnation in the economy, and that I think keeps the Fed on hold for sure. In other words, I think the inflation rate, which is right now 2 to 3%, goes up to 3 to 4% pretty quickly here. That's been signaled by some of these regional business surveys of pricing. So I think inflation is going to heat up here. It's going to be kind of like a mini version of what happened during the COVID pandemic with supply chain disruptions. On the other hand, I think the unemployment rate is actually going to stay fairly close to 4%. That's not an environment for the Fed to lower interest rates. So I think the message from the Fed is going to be more of the same, which is they're in no hurry at all to lower interest rates.
Ed, we got to go. So that means
Yeah.
probably not 100 basis points of cuts this year, right?
No, not at all.
Ed, thanks so much for taking the time this morning.
Thank you.